Good evening. Welcome to Economics 330, Global Trade and Political Economy. This is the City University of New York, Medgar Evers College. Today is Tuesday, March 18th, 2025. And welcome to Module 8, Week 8 lecture. And just before we get into today's lecture, a quick announcement. On Tuesday, April 1st, and I assure you this is no April Fool's joke, we would have a 2-week period to complete the semester's term paper. The term paper would be in lieu of a midterm. So we would go into a little bit more detail about the term paper next week, Tuesday. But as you may know, we don't have class on March 31st. So the first day of the week, for the week of April, week beginning April, March 31st, would be April 1st. And you will have between Tuesday, April 1st to Friday, April 11th to complete your midterm. And right after you turn in your midterm begins your spring break. Right next day, Saturday, April 12th, your spring break begins. So we have one more week, and then we go into a 2-week period where you would have you would have a 2-week period to complete your spring break, your term paper, which will be in lieu of a midterm exam. So now that I've gotten that out of the way, let's dive into this week's lecture. So in the past 3 weeks, we have completed a 3-part study of the 3 theoretical perspectives of global trade. This really sounds like a tongue twister. But anyways, these 3 theoretical perspectives include 1, the liberal perspective, 2, the realistic perspective, and 3, historical materialism. This week, we will begin a new 3-part study of international trade relations and their components. And these components include international monetary relations. That's the first of the 3. The second of the 3 is global trade relations. And number 3, or third, but not the least, is regional trade agreements. So again, international monetary relations, global trade relations, and regional trade relations. International trade activities are driven by resource transfers, i.e. money. Therefore, one must understand the nature of the international monetary system in order to appreciate global trade relations. In a 3-part, 3-week study that begins this week, we will address how nations relate to each other in the process of trade. For example, one country can limit the exportation of certain goods, or trade could be encouraged freely by one country, but limited by another. We will also address the question, what are the reasons for tensions and conflicting differences in policies? One way of resolving conflicts will be to negotiate cooperation between nations and sometimes groups of nations. And again, some of these are regional agreements beyond the global agreement under the World Trade Organization. So as we will get into in the weeks ahead, there are global trade relations as overseen by the WTO, and as undergirded by the IMF to ensure that countries have the fiscal stability to be able to engage in global trade relations. But beneath that are also regional trade arrangements. One example of this regional trade arrangement would be, say, in the US is USMCA, which is US, Mexico, and Canada Trade Agreement that used to be NAFTA, North American Free Trade Agreement. As you may know, NAFTA evolved into USMCA, and there is currently trade tensions. As you may know, President Trump, during his first administration, oversaw the negotiations that had NAFTA transition to USMCA. So you will be interesting to see what other concessions or agreements US, Canada, and Mexico would need to reach in order to strengthen USMCA and forestall the current tariff and counter-tariff charges that are going across all three countries. For those of us who have Caribbean origin, I don't have Caribbean origin, but for those of us who do, there is CARICOM. For others who are from Africa, there is the African Continental Free Trade Area. There is, of course, the European Union. And we will eventually get into the different kinds of regional trade agreements. There is, of course, ASEAN in Asia and countless others, which we will get into a little bit more details with when we get into the week that delves into regional trade agreements. So since this course is based on global trade and political economy, we will discuss the mechanics of money and trade. Beginning with balance of payment, we will discuss how monetary flows affect the ability of a nation to transact international business with others. As an example, if a nation is unable to trade due to monetary limitations or imbalances that may temporarily pose problems when they seek arrangements. So if a nation is unable to trade due to monetary relations or imbalances that may be temporary, these may pose problems when they seek agreements to help them address the temporary problems. This could lead to long-standing or lingering inability to participate in global trade. Addressing this challenge through bilateral arrangements rather than institutional support from the IMF. So bilateral arrangement is when two countries reach an arrangement, right? Rather than seeking institutional support, which sort of going to IMF or other lenders. So bilateral is two countries reaching an agreement. Say one country, as you may know, part of what's also going on in the news is the shrinking of USAID, and with that, development assistance from the United States. So development assistance that the United States gives to a developing country will be a bilateral facility. That means from one country to the other. This is distinct from a country seeking support from an institution, which is called institutional support, i.e. the IMF, right? So when a country seeks to address challenges through bilateral arrangements, rather than institutional support from the IMF, this may lead to political control of one country by another, which in turn could create international political issues within and between nations. So if you were just to dial back to some of your quiz from last week, there was a question that dealt with why would the elite in developing countries cooperate with global institutions that the Marxist school of thought would argue is unfair to developing countries. So this will be some of the dependencies that the Marxian theory of international relations would argue that when countries deal under a bilateral arrangement, that it increases the probability of a dependency relationship. So just something to bear in mind, at least relative to your assessment from last week. So let us then begin with a brief overview of the evolution and history of international monetary relations. Historically, gold has been used as the reference point for currencies. The system of tying currency values to gold functioned quite well until the mid-20th century. The gold standard system in the early 1900s pegged the value of gold at, that is $5 per ounce, US dollars, that is. Now that we're in the international space, it is helpful to bear in mind that there are several nations with currencies that are named the dollar. Indeed, our neighbors to the north, the Canadians, also have the dollar, a different dollar as the national currency. Of course, that's the Canadian dollar, as do the Australians and I believe New Zealand, among others. So the gold standard system in the early 1900s pegged the value of gold at 35 US dollars per ounce of gold, which was the reference point other nations used in fixing the value of their currencies. It is important to note that this price was not the commodity price of gold. Indeed, private investors could not purchase gold at this price point. Governments had exclusive rights over private individuals to buy gold at this below market price, thus reducing the volatility of currency values. In 1944, the US government pursued an expansionary monetary policy in a bid to financially support World War II efforts. Again, there was a question in your quiz from last week's assessment that dealt with this particular issue. So again, in 1944, the US government pursued an expansionary monetary policy in a bid to financially support World War II efforts. Please note that expansionary monetary policy involves a reduction in taxes and an increase in government spending. Both measures are meant to stimulate the economy and increase the level of economic activity. However, this policy caused inflation to rise and resulted in the US dollar losing value fairly quickly. I hope we both all understand the basic economics that when there is an inflation, all things being equal, the local currency loses purchasing power or value. Inflation means that stuff you could buy today for $1, as an example, will now cost $1.25. And that means your dollar is buying you much less. Of course, a big topical example of this right now is a dozen eggs. A dozen eggs used to be about $3.50, and now you'll be lucky to find one at $6. So that's inflation. So with vis-a-vis eggs, you can see how the dollar is losing value because it now takes more dollars to buy the same amount of egg that we used to be able to purchase for $3.50 or something like that just a few months ago. So the policy of expansionary policy caused inflation to rise and resulted in the US dollar losing value fairly quickly. Consequently, other nations began quickly stockpiling gold to prevent fluctuations in their own currency. Right? So as a hedge to challenges in the devaluation of the dollar, countries started hedging with gold and started stockpiling gold as a way to hedge the volatility or the depreciation that was created by the dollar losing value. Eventually, this practice became quite unsustainable. That is, the practice of the dollar losing value and other countries stockpiling gold to prevent fluctuations in their own currency. So eventually, this practice became quite unsustainable due to placing unrealistic demands on the inflation of the US dollar. Thus, in 1944, the gold standard was abolished and was replaced with the pegged exchange rate system. So the beginning of the end for the gold standard was the US expansionary fiscal policy to finance the Second World War. That created a devaluation of the dollar. And as other countries began to hedge by purchasing more gold, the system became unsustainable. And the global economy had to move away from the gold standard, and in 1944 transitioned to a pegged exchange rate regime. And we are going to get into that in some detail as we go forward. But now that we have established a foundational overview, let us then transition to this week's learning objectives, which is first, to explain the term balance of payment, aka BOP, and how this concept affects the ability of a country to participate in global trade. A balance of payment, also known as BOP or international balance of international payment, is the difference in total value between payments into and out of a country over a defined period. Put differently, the BOP is the method by which countries measure all of the international monetary transactions within a certain period. The BOP consists of three main accounts. One, the current account. Two, the capital account. And three, the financial account. Note that current account is meant to balance against the sum of the financial and capital accounts, but they rarely do. Already rarely does. So I'll say that again, that the current account is meant to balance against the sum of the financial and capital accounts, but rarely does. The balance of payments transactions consist of imports and exports of goods, services, and capital, as well as transfer payments, such as foreign aid and remittances. A country's balance of payments and its net international investment position together constitute its international accounts. Globalization in the 20th century led to BOP liberalization in many emerging markets. Developing countries lifted restrictions on balance of payment accounts to take advantage of the cash flows arriving from developed foreign nations, which in turn boosted their economies. Second learning objective for the week is to describe the International Monetary Fund and how it facilitates world trade. This is critical. To which, one way to think about what IMF is and how it functions is that the International Monetary Fund, founded in 1944, is a voluntary financial institution with a membership of 184 countries. It fosters among these countries cooperative monetary policy that stabilize the exchange of one national currency for another. It therefore and thereby encourages international trade. The IMF provides a mechanism in which each member country can cooperate with the others to promote its domestic economic prosperity and that of the entire membership. The IMF maintains an extensive database of statistics on members' economies and on the world economy as a whole, which it shares with every member country. At the request of a member, it extends technical assistance in financial, fiscal, and economic matters. And this next point is crucial. If persuaded that a member country is behind in payments to other countries, the IMF would implement reform policies. The IMF will also lend money to tide that member over until the reform takes effect. Lastly, the purposes of the IMF are clearly expressed in Article 1 of its constitution, the Article of Agreement, and it includes, first, to promote international monetary cooperation through a permanent institution which provides the machinery for consultation and collaboration on international monetary problems. Two, to facilitate the expansion and balanced growth of international trade, and to contribute thereby to the promotion and maintenance of high levels of employment and real income, and to the development of the productive resources of all members as a primary objective of economic policy. Three, to promote exchange rate stability, to maintain orderly exchange arrangements among members, and to avoid competitive exchange depreciation. Four, to assist in the establishment of multilateral system of payment in respect of current transactions between members and in the elimination of foreign exchange restrictions which hamper growth of the world trade. Five, to give confidence to members by making the general resources of the fund temporarily available to them under adequate safeguards, thus providing them with opportunity to correct maladjustments in their balance of payments without resorting to measures destructive of national and international prosperity. And sixth, in accordance with the above, to shorten the duration and lessen the degree of disequilibrium in the international balance of payment of members. So the third learning objective for the week is explain how exchange rates are used to manage world trade by individual nations. It is helpful to begin by differentiating between floating, fixed, and pegged exchange rates. So there are three kinds of exchange rates that we will cover. The first exchange rate is the floating exchange rate. The second is the fixed exchange rate. And the third is the pegged exchange rate. Advantage of, and each regime has advantages and disadvantages, and we will quickly, very quickly go through them. Advantage of floating exchange rate. Currencies is that it can be traded without any restrictions, unlike currencies with fixed exchange rates. Hence, government and banks do not need to resort to continuous management process. Floating rates enhance the efficiency of the market, especially as a country's macroeconomic fundamentals affect the floating exchange rate in global markets, influencing the flow of portfolios between countries. In a floating exchange rate, central banks are not required to keep large foreign currency reserve amounts for defending the exchange rate. Hence, the reserves can be utilized for promoting economic growth by importing capital goods. But there are disadvantages also of a floating exchange rate. Remember, earlier in this semester, I mentioned that there are some fundamental phrases, there are some phrases and words that are key to communicating that you have a technical understanding of global trade and political economy, and that are fundamental to understanding the context in which you're able to evaluate issues that come up in global trade and political economy. One of those critical phrases is to have dialectical thinking, which is to see an issue from both sides rather than black or white, which is good or bad. So we have gone through some of the advantages as one example of a floating exchange rate regime. Now, let's discuss the disadvantages of a floating exchange rate, which includes that it's prone to fluctuations and are highly volatile by nature. So because in a floating regime, the market determines the value of your currency. The demand for your currency determines the value of your currency. It has no intrinsic value beyond the market fundamentals of your economy, and therefore demand for your currency. And you can quickly see how market sentiments can shift from day to day and therefore create a bit of volatility. So a currency value against another currency may deteriorate only in one trading day, right? So from one day to the other, the value might continue to fluctuate and create a little bit of volatility, which can make it that much more challenging for investors to plan long term. The lack of control over floating exchange rates can limit economic growth or recovery. So realize that currency devaluation can be a tool to make exports more competitive, right? So when a country that has a strategy to grow its economy through exports, and if the country is facing a little bit of an economic headwind, one tool in the tool bag of the central bank of the country to stimulate growth could be to devalue the currency and therefore make its exports cheaper relative to or its trade competitors, right? So the negative currency exchange rate movements may lead to serious issues. For example, if the dollar rises against the euro, it will be more difficult to export to the Eurozone from the US, right? Because that means the value of the dollar rises relative to the euro. It would mean that it will require more euros to buy more the same goods from the United States. And you can see how, if you're a European merchant or consumer, you could begin to look for other sources for the same goods, sources presumably that have weaker currencies than the US dollar. But if the market is controlling your currency, in this case, the United States will lack the tools to directly influence the value of its currency by devaluing it to make the goods and services more competitive. Again, devaluation also comes with a lot of challenges. Let me just put that out there, but let's not digress too much. If a country is suffering from economic issues, such as unemployment or high inflation, floating exchange rates may intensify the existing problems. For example, depreciation of the country's currency already suffering from high inflation will cause inflation to increase further to an increase in demand due to an increase in demand of goods. Moreover, expensive imports may worsen the country's current account. So the next exchange rate is a fixed exchange rate, also known as the gold standard, which quantifies the value of currencies by using a stable reference point. Historically, gold has been used as the reference point. This is because it is a valuable commodity worldwide, and its value is less susceptible to fluctuations in interest rates. The next is a pegged exchange rate system, which incorporates aspects of a floating and fixed exchange rate system. Smaller economies that are particularly susceptible to currency fluctuations will peg their currency to a single major currency or a basket of currencies. These currencies are chosen based on the country the smaller economy experiences a lot of trade activity with, or which currency the nation's debt is denominated in. As an example, many Caribbean countries peg their currency to the US dollar. This would make sense given this example as I just stated, because most of the trade that occurs in the Caribbean countries is with the United States. There are lots of tourism, and tourists want to have a clear picture of how much they can purchase with that dollar, and they need a little bit of clarity and certainty, which a pegged regime would offer them, right? The other is that, if you remember, we also discussed bilateral assistance, right? Sometimes bilateral assistance is privately funded, where a country in the Caribbean, let's say Jamaica, just because, is seeking for facility to finance a rapid mass transit system. right? It needs to be, that company would need to be able to calculate how much fares it can charge to be able to pay off whatever credit facility it attracts in dollars to buy the buses for the rapid transit system. And for the company to be able to do that, there needs to be a little bit of stability in the value of the Jamaican currency. And one of the ways Jamaica could choose to do that would be to peg its currency to the dollar, to say that, okay, Jamaican currency will be 3 Jamaican currency to $1 as an example, right? And that's one of the ways to bring certainty to those investments. So lastly, it is helpful to note that countries should have a macroeconomic growth strategy, a theory of growth. This may include a combination of A, an import-led economy, B, a domestic consumption-led economy, or C, an export-led economy. So this will conclude our formal lecture section. We will now transition into Q&A. And again, note quickly that next week's lecture would be on global trade relations. And in addition to that, we would have a brief overview of your midterm paper. And so for the 2 weeks after that, you would have your midterm. And after that, you would have some spring break to unwind. And we will see 2 weeks after that. But we're getting way ahead of ourselves. We're still 3 weeks away from spring break. But anyways, I will stop the recording now.